Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Strong US factory data pushes markets to rethink the number of Fed cuts this year. Odds of a June cut dipping below 50%. Iran vows a decisive response after it says an Israeli strike on its embassy in Syria killed 2 military generals. This as Israel agrees to in-person talks with the US over an invasion of Rafah. Plus, oil nears a 5-month high on that heightened risk in the Middle East and tighter supply. Well, a very good morning. Welcome to Tuesday. I hope you had a lovely Easter break. You've had a chance now to digest that central bank bonanza, but it's going to be a lively one ahead. We've got lots of eco data on the docket, amongst lots of Fed speak as well. 19 I counted, including Fed Chair Jay Powell himself. But we've already had a solid set of US factory data reinforcing this narrative that the US economy is more resilient than economists had expected, that inflation's falling more slowly than economists had expected, hence why you've got this narrative reinforced that the Fed's not going to be in a rush to cut rates. So you saw stocks joining the losses in bonds yesterday, and that is set to continue later. Futures stateside pointing to a lower opening, but in Europe slightly tilted to the upside, maybe a bit of brightness closer to home. But if we flip the board over to the cross-asset picture, you've got the 2-year Treasury yield currently, we'll show you in a mo. But there we go, 4.69% on the 2-year Treasury yield, as traders have pushed back pricing for their first full Fed cut to September. For a moment, you saw the odds of a first move in June dipping below 50%. And therefore, now all eyes turn to that US jobs report for March on Friday. The dollar currently pretty steady there. Brent trading just below $88 a barrel as we've got all those tensions in the Middle East ratcheting up and tighter supply from Mexico. Oil really near a 5-month high on all of that, and we'll dig into it later. Gold as well has been hovering near record highs and currently trading at $2,257 an ounce. But let's get over to Vonnie Quinn. She's on standby for us in Dubai with an update on how Asia markets are faring. Vonnie, what's happening where you are?
Lizzie, it's been a fascinating session because all these cross currents coming together right now. As we know, this is some markets' first reaction to the PCE data, which already came out last Friday, right? So Hong Kong, for example, had been closed yesterday. It's now reopened, so we saw a huge catch up there. But let's start with the yen, because really a lot of activity around the yen today. Mark Mobius telling his Linda Amin earlier that anyone who is short the yen, well, they might be in line to make some money, and that this is a losing battle for the authorities in Japan. We are at, as you can see, 151.76. 152 is a line in the sand, potentially. We might see intervention there. But as Mark Cranfield of M Live said earlier, why should it be 152? It could be anything. And the ministry and the officials in Japan have been good about sort of, wrong-footing traders. So if traders think it's 152, well, they might just let the yen weaken past 152 before they do anything about it. Anyway, that's all playing out. The last time we got an intervention was 2022, and it was below the level that we're at now. Previously, it was 1998, so that is going to be a huge deal for the markets. As you can see, the Nikkei 225, well, it has turned just barely positive, but it was a very down session for the Nikkei yesterday, 1.4% lower, in fact. One of the narratives that was percolating through the markets was that perhaps this might be the end, or at least we might be approaching the end of the Nikkei's upcycle, and that China could be a beneficiary of that. Well, we'll see. It has to play out. The Hang Seng, a catch-up rally, 2.25%. Some great stories out of Hong Kong today, including Xiaomi. As you can see, it's up a whopping 11.5%. The story there is that it unveiled its first EV model, and orders went gangbusters. In the first 24 hours, we're talking about 90,000 orders. That would put it on par with Tesla in China if that were to continue. We flipped up the board. So as you can see, across Asia, if you take it as a whole, the Asia-Pacific index up about 0.3%. China, though, is hesitating just a little bit. We're seeing the CSI 300 now down 0.4%, even after we got that better than anticipated PMI data out of China as well. It wasn't just the US. We got manufacturing data that was very strong in China too, which was a major surprise. Korea down 2.2%. We're seeing stickier inflation in Korea as well, and that's also causing the central bank to perhaps hold off on a cut. And then in India, down about 0.1% on the Nifty, which has been rallying this year. That's the other narrative that might be playing out in this market. Is it India's turn to give back some money? Are investors turning away from India potentially and back to China as well, Lizzie?
All right, a whistle-stop tour of Asia. Thank you. Bloomberg's Vonnie Quinn. And I'm glad you mentioned the yen, Vonnie, because dollars gain is yen pain. So let's dig more deeply into all of that economic data we've had out of the US. Strong factory data prompting traders to price in less monetary policy easing by the Fed this year, briefly pushing the odds of a first move in June below 50%. And markets also weighing cautious comments on Friday from the Fed chair, Jerome Powell. We can get some analysis now from Bloomberg's Jill Deese this morning. Jill, you've got traders cutting their rate cut bets again off the back of this data. How doubtful is a June cut looking now?
Yeah, Lizzie, I think that at this point, it seems like traders are really paring their bets to the point where we're pricing in maybe a 50% chance that we're actually going to get that June rate cut. It's a really far cry from where we were just a few months ago when we were expecting a rate cut, or at least traders were expecting a rate cut as soon as March. But of course, as you see from some of this data, it's just that the economy has been so much more resilient than initially anticipated. Getting that ISM data, beating expectations, I think really added to those complications, even though you had a little bit of cooling in that core inflation gauge last Friday that the Fed really cares about. All of this is really combining to show that the picture for when exactly that trajectory for rate cuts to start is actually becoming a little bit less clear. Of course, as we've been talking, we know that we're getting some additional jobs data. Hopefully that shows us a little bit more about where we're at in terms of the labor market. First, looking at this upcoming JOLTS data, and then ultimately the jobs report, I think will give the Fed a little bit more clarity on when exactly they can start cutting. But yes, it's still a pretty murky picture there overall.
OK, so that June cut on a knife edge. Of course, we also get 19 Fed speeches, I counted, apart from Jay Powell, of course. Who are you listening to?
Yeah, I mean, I think that at this point, obviously Powell is really going to sort of set the directive there. I think it's really interesting to hear from, somebody like Bostic, exactly on when they're really pricing things in. I think you really kind of, Lizzie, have to take the totality of where some of these statements are coming in, because looking back at those Fed minutes, looking back at that Fed meeting just a couple of weeks ago, getting this idea that, a lot of them are expressing patience over the data. You really want to pay attention to who's keying in on, the next CPI report, who's keying in on this upcoming labor market report. I think we'll kind of see how that develops, over the next couple of weeks as we get into, I guess a bit closer to June, because, again, I mean, if we're sitting here on a 50-50 chance of something, we want to know whether there's going to be crystallization about a cut, by the time we're getting into May, at least.
OK, so all eyes on that March jobs report on Friday. Bloomberg's Jill Deese, thank you for that update. Now, I want to get back to the geopolitical story because, of course, as we mentioned, it is affecting the oil price. Iran and Syria say that this Israeli airstrike on Tehran's embassy compound in Damascus has killed several people, including 2 military generals. Iran's foreign minister says Israel should be held accountable for the repercussions of the attack as the tensions grow between these two long-time adversaries. Joining us now for more is Bloomberg's Patrick Sykes in Istanbul. Patrick, what more do we know about this attack?
Morning, Lizzie. I think it is certainly an escalation between these two long-time enemies. You've got them technically targeting Iranian soil here, right? It's in Syria, but being the consulate compound, it is affiliated to Iran itself in a way much more directly than previous similar attacks we've seen, where they've perhaps targeted military personnel or Iranian proxies, but not in this direct way on what's technically Iranian territory. There was footage overnight showing the aftermath. It's the sort of one building still standing where you can see the government's poster still up, and the building next to it completely flattened. The car outside completely burnt out. We know that the two targets, Mohammad Reza Zahedi and his deputy, both there as military advisors from Iran to Syria, and he's got a long history in the Revolutionary Guards Quds Force. That's the expeditionary force responsible for bringing Iran's revolutionary ideals abroad to the region.
Yeah, you kind of have to wonder whether this is Netanyahu using the war with Hamas to take the fight to Iran. What's been Iran's response, and what are its options here?
Yeah, it's that tricky balancing act where they're going to absolutely feel the need to respond, but they're also constrained by, I think, a practical prerogative to not invite further response themselves. But already we've seen, I think, Iran going further than it has in previous similar cases. You mentioned the foreign minister's statement. This time they also summoned the Swiss attaché who represents US interests in Iran, US of course not being there themselves. That's not something you usually see when this happens. We also found out just an hour or so ago that the top National Security Council met late last night, and a statement said they took appropriate decisions without elaborating. So they're already signaling that this is being taken seriously, and they're sort of telegraphing that there will be a response in a more public way than they have in previous similar attacks. The question, of course, is do they do something similar? Do they try and attack Israel on its own territory? That would, of course, be a huge escalation. Or do they find some kind of proximate equivalent like this, extraterritorial territory, like in the case of the consulate? It's a tricky balancing act for them.
OK, Bloomberg's Patrick Sykes, thank you for that update. As we have the US-Israel meeting back on the docket in person after it was cancelled and then made a video call, back on the schedule now in person. Well, that is the geopolitics. Let's get you up to date with what we have on the docket for the week in terms of eco data. It's set to be a busy one. On Wednesday, tomorrow, we get Eurozone CPI, which you might take with a pinch of salt, given the timing of Easter. On Thursday, it's Euro area PMIs. And then on Friday, it's the US March jobs report. Really the highlight of the week in terms of eco data. As we say with Jill, you already saw in the ISM manufacturing survey the employment side of the report showing declining demand for workers. This report, of course, is going to be hugely influential in terms of those Fed rate cut bets. We've also just had the news crossing the terminal that UBS is going to launch a new share buyback programme of up to $2 billion. This after we saw UBS cutting its bonus pool for last year by 14%. A tough year for deal makers and traders. You saw the CEO, Sergio Ermotti, being elevated to the rank of the best paid European boss. But of course, the buyback programme very much in focus given the merger. We've just passed the 1 year anniversary, and from UBS's statement on the UBS's statement, they say we intend to commence a new 2024 share repurchase program of up to $2 billion. As previously communicated, we expect to repurchase up to $1 billion of our shares commencing after the completion of the merger between UBS and Credit Suisse, which is expected to occur by the end of the second quarter. They say their ambition is for share repurchases to exceed their pre-acquisition level by 2026. I'm sure we'll bring you more on that story throughout the programme. But you can get a roundup of the stories that you need to know to get your day going on the Daybreak newsletter. Go to DAYB Go on the terminal. Coming up, Turkey's president suffers an unprecedented defeat in municipal elections, and we're live in Ankara to discuss the fallout. That's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. It's 6:16 here in London, and we'll go to Turkey now, where the president, Recep Tayyip Erdogan, has suffered an unprecedented defeat at the ballot box. The AK party fell behind the main opposition CHP in Sunday's municipal elections, and it's the first defeat since President Erdogan swept to power more than 2 decades ago. We can get more now from our Turkey economy and government reporter, Beryl Akman, who is in the Turkish capital for us. Is this, Beryl, a watershed moment for President Erdogan?
I think you could say that, as you just mentioned, it is a rare defeat for President Erdogan since he came to power initially as prime minister about 2 decades ago. And it is a historic moment for the opposition, where we rarely seen them take strongholds from AK Party, especially in local elections. Now, 5 years ago, in the local vote again, we had seen the opposition capture Istanbul, the country's commercial hub, as well as capital Ankara and some other major cities in the west. But this time, it's a landmark victory because they've been able to take control of cities that AK Party and President Erdogan has ruled for decades, even before, with the predecessors of Erdogan's AK Party. So it is definitely a show of force against the president and a watershed moment, I'd say, yes.
And is it a watershed moment for Turkish macro policy, Beryl?
Oh, we're yet to see what's going to happen with economic policy. Now, Turkey is prone to policy swings, and we've seen in the past how election results or major events impact economic policy. But for now, when President Erdogan on Sunday conceded defeat, he signaled that policy, this normalization path we've seen since the president's re-election in May, to continue, saying that inflation, we've seen inflation slow down as of the second half, and the program would continue, which includes aggressively tight monetary policy with the benchmark rate at 50% right now, as well as fiscal discipline, which the president's finance minister has said we'd see even more savings and more fiscal discipline after elections. And investors and big banks do not see any immediate risk to an immediate shift in policy for the time being. Now we have inflation data tomorrow, which is expected to show consumer inflation annually edging towards 70%, and we'll see what the economy authorities will do, whether they'll have to tighten policy further.
All right, Turkey economy and government reporter Beryl Akman, we thank you for that. And we're going to continue the conversation about the impact on the lira later in the programme with Trang Nguyen, who is BNP Paribas Global Head of EM Credit Strategy. But coming up next on the programme, Australia's central bank says that it's going to introduce a new system for the implementation of monetary policy. We'll bring you our exclusive conversation with the RBA Assistant Governor Christopher Kent. That's up next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Australia's central bank is set to switch to a new framework for the implementation of monetary policy. The RBA's Assistant Governor for Financial Markets outlined the changes in a speech at our Sydney office. Christopher Kent spoke earlier to Bloomberg.
What we've announced today is a new system for implementing monetary policy, what we'll be transitioning to in the future. But I wanted to emphasise that really is about the plumbing, the nuts and bolts of moving money around, about us achieving our cash rate close to the cash rate target, but it's not what that target is. What that target is monetary policy. This isn't about monetary policy, it's just how we achieve the target at any given time.
But it's also about responding to perhaps some of the imbalances within the system structurally coming from the last few years.
Well, it's about responding to the running down of the very large level of reserves. We call that excess reserves that are in the system, because we and other central banks pursued unconventional monetary policy. So they put a lot of money in the bank's accounts. Those are gradually unwinding as our bonds mature, as the TFF gets repaid. So it's about looking to the future and thinking about how, what we need to do to sort of what system we need to transition to.
When it comes to the moderation of that balance sheet, obviously a lot of it will depend on underlying demand, but do you have sort of an idea of scale, of timing, of how that framework will play out?
No, we don't, and indeed that's partly why we picked the system we've picked. So what we've chosen is what we call a full allotment allocation system at our OMOs. That means the banks come to us and for a fixed price they can borrow reserves, pledge collateral for 28 days at the moment, and they can take what they want as long as they have sufficient collateral. So what that means is the supply of reserves is going to depend on the bank's demand. The banks have their own estimates. We could come up with some rough ones, but until we get there we won't know. But it should transition fairly seamlessly from one of excess to ample, and we'll know we're there when banks start showing up in larger numbers and larger quantities at our operations on a weekly basis.
I think until we get there, we won't know. Probably, is a good phrase to describe a lot of aspects of where we're at the moment in terms of monetary policy. Upstairs, you were asked, a little bit cheekily to give one word to describe monetary policy settings and trajectory. I'm going to give you a few more words if you want. Can you elaborate?
Yeah, I think the starting point is just to say that the board's made it clear it thinks the interest rate path that will best bring inflation down in a timely manner is uncertain. And so they've not wanted to rule anything in or out with regards to interest rate changes. We're in a better place than we had been. Inflation's come down a long way. It does look to be moderating, but the path, according to our forecasts, is a gradual moderation from here. Labour market pressures, they're easing. They're still tight, but they're easing, and that's because growth's slowing, and so that brings demand into a better balance with supply. So all those things are in place. Our central forecasts are sort of predicated on sort of further good things happening, including productivity growth, but there's a lot of uncertainties around that. And I think the key point is those are reasonably well balanced as best we can tell, and because of that, the path's uncertain. The next rate change, don't know if it's higher, don't know if it's going to be a lower interest rate.
When you talk about the inability to rule out shocks, right? How much of those risks do you worry about that might be external, that might be geopolitical, that might be election driven, the policies of other countries, and how much of it are sort of domestic, maybe structural macroeconomic aspects that perhaps we haven't seen in the data sets yet?
I think it could be both. We just don't know. But I mean, as a small open economy, we're always subject to developments offshore. We've talked quite at length about what's happening in China. China's a major export market for us, and there are concerns there about their property sector and the problems that they're trying to deal with there. So that can have an impact on things like the demand for our key commodities like iron ore, and that can move our economy around. But equally, domestically, things can be moved by what people here in the Australian economy are doing, particularly households at the moment. How are they going to behave in the future? That will sort of be a key point for where the economy goes.
So that was RBA Assistant Governor Christopher Kent speaking earlier to Bloomberg. We are looking at US futures pointing to a lower opening today. This is after the S&P closed lower 0.2% yesterday. Stocks joining the losses in bonds after that US factory data, which was stronger than expected, reinforcing the narrative that the Fed is not in a rush to cut rates. You've got traders now pricing for the full first cut to come in September, so pushed way back from the start of the year. In your bond space, not a whole lot of movement across the curve. The 2-year Treasury yield at 4.69%. Coming up, oil nears a 5-month high on Middle East risks and tight supply. We'll dig into that next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Strong US factory data pushes markets to rethink the number of Fed cuts this year. Odds of a June cut dipping below 50%. Iran vows a decisive response after it says an Israeli strike on its embassy in Syria killed 2 military generals. This as Israel agrees to in-person talks with the US over an invasion of Rafah. Plus, oil nears a 5-month high on that heightened risk in the Middle East, as well as tighter supply. Well, we'll dig into all of those stories throughout the programme. Lots of geopolitics to get our teeth into, but it is a busy week ahead for economic data. You've already had a little bit of it from the US factory data, and as I say, it has pushed back Fed rate cut bets. There was a moment where you saw the June cut pricing dipping below 50%, and you can see on the picture there the impact in terms of stocks. It's meant that stocks joined the losses in bonds yesterday. The S&P closing down 0.2%, and Wall Street set to open even lower today. Not the case in Europe. A bit more optimism, flat to the upside when it comes to Euro Stoxx 50 futures. But if we flip the board over to the cross-asset picture and you look at treasuries, there's not a whole lot of movement. The 2-year treasury yield at 4.69%. But you have seen, as I say, traders pushing back their pricing for the first full Fed cut to September. And now all eyes turn to that US jobs report for March on Friday. The dollar pretty steady at the moment, higher 6 basis points. Oil, though, just below $88 a barrel. This is on all of the geopolitical risk in the Middle East, also the supply tighter from Mexico. And you've got gold hovering near record highs, currently trading at $2,254 an ounce. Meanwhile, the yen is weakening towards 152 per dollar. It's a key level that traders see elevating the chances that Japanese officials will bring us that yen intervention. Let's get more from Mark Cudmore, Bloomberg Markets Live executive editor. Morning, Mark. Spring is here. Is it time for the yen to blossom?
Good morning, Lizzie. It is absolutely not time for the yen to blossom. There won't be any cherry blossoms here for this currency, I'm afraid. Look, I think, whether there's intervention from the MOF, it'll only lead to some short-term gains. Overall, the fundamental reasons for yen weakness are structurally still there and will not change an intervention and have not changed based on recent BOJ action. The fact is, Japan still has deeply negative real yields, and they're far more negative than the rest of the world. And that is, even though it's got deeply negative real yield, it's not like its economy is booming. They're still fighting a deflationary mindset. Now, I know that they've had positive inflation prints the last couple of years, but it's not exactly runaway inflation in one of the biggest global inflation threats that we've had in 40 years. And so therefore, I think the structural reasons for yen weakness remain the same, and it can continue to weaken even after intervention. Intervention might lead it strengthened for a couple of days, but quickly traders will sell into that.
So that's the internal story in Japan, but how much is the resilience in the US economy feeding into it? And Mark, where are you on this 50 versus 75 basis point rate cuts from the Fed debate as we've got all of this eco data coming in?
I just don't see how the Fed can cut even 50. I would be shocked if we get more than 25 basis points this year. Look, we have a strong labour market. We have a consumer that's continuing to spend. We finally had manufacturing sector come out of contractionary territory. I know it's a smaller part of the US economy, but it's a good lead indicator because it matters for hiring, etc. as well. So all parts of the US economy are still strong. The Fed December meeting, they sent a very, very dovish message, and that reignited an economy that might have been starting to slow. There is no landing out there. I know the Fed has expressed desperation to cut, and I know they're going to try getting away with 25 basis points at some point. I'm not even sure they get away with that, and I don't see them being able to do more than 25 basis points unless there is some crisis. And I don't see where the crisis is going to come either. Sure, some regional banks are going to go because of commercial real estate, but it's not systemic. Sure, private markets have some stretch valuations, but again, it's not systemic. It's not going to be the pillar that's going to take this out. There's nothing on the horizon which is looking likely to derail this economy at the moment, and therefore it's going to be very, very hard for the Fed to sell cuts no matter how hard they try. So I don't think we get 50 basis points. I'll go for something further. I think it's more likely that we'd get something like 150 basis points than 50 basis points. That may sound strange, and what I mean is the only justification for the Fed doing more than one token gesture cut would be because the US economy does have a problem, does go into crisis, in which case the Fed will need to cut much more aggressively. But I think yields need to go much higher from here still.
Not even core PCE, the Fed's preferred inflation gauge coming in line with expectations could knock your confidence. Mark Cudmore, we thank you. Bloomberg's Mark Cudmore there. Now, let's go to oil. It's holding near a 5-month high with heightened geopolitical risks and supply constraints boosting prices. And for the latest, we've got Bloomberg's senior energy reporter in Singapore, Stephen Stapczynski. Stephen, thanks for joining us. What more can you tell us about this rally in oil prices?
You know, oil's up over 10% so far this year. There are a number of reasons, as you mentioned. There is that geopolitical risks that you mentioned with Iran and the tension there as well with Israel and what's going to happen to the region. That's honestly been a story for the last 6 months. But what I think is really driving the oil market now is just plain fundamentals. You look at what OPEC Plus is doing. They've cut back. They've kept their production cuts in place going into the second quarter now. The market is a lot of the supply is the froth is being kind of sucked out of the market. And then on top of that, there are some sort of pressure points. One of them being yesterday, Mexico. Bloomberg reported that they canceled some contracts for some of their heavier grade crude exports to refineries in the U.S. and other places. That means that U.S. refiners are going to have to find supply elsewhere. And you're already seeing an indication that U.S. prices are kind of trading at a premium because of that. And there's also risk that potentially Cushing oil inventories are also kind of trending lower there as well. They're at the lowest seasonal level in about 2 years. So there are some fundamentals in the markets beyond just this geopolitical risk sort of thing that you're looking at. Certainly that is part of it, and there is that risk premium in oil prices. But we're finally beginning to see true fundamentals driving the oil market. And when you're also looking at the bullish bets in the market, that's also at the highest level in months, in about a year, as people are expecting that this rise, Brent is around right below $88 right now, this rise to potentially $100 a barrel is sort of potentially in the cards. Now, there is a lot more uncertainty. What's going to happen with U.S. production? What's going to happen with Mexico ahead of the election? Are they going to keep reducing their exports? What's going to happen with Chinese demand? But in all, it does seem that there is this bullish sentiment, and oil is going to trudge higher over the next few weeks and months.
So it's not all about geopolitical risk, it's also about supply cuts. Speaking of OPEC Plus, when it meets tomorrow, Stephen, what can we expect?
We're going to expect them to keep the cuts in place. I don't think there are very many people in the market that are expecting a surprise. This is precisely where OPEC Plus, and by OPEC Plus I really mean Saudi Arabia, wants the oil market, right? They want prices above $80. If they go above $100, then you have, gasoline prices rising around the world. You have your customers knocking on your door. But this seems to be the sweet spot, this $88 level. And so I think what to expect is just a rubber stamp. They expect that the market requires these production cuts to continue. They're likely going to say very little or nothing at all about the third quarter and what they're going to do moving forward into that. But overall, I think it's going to be a rubber stamp event. If it's not, then you could see potentially maybe some fireworks in the market going one way or the other.
All right, well, Brent trading at $87.81 a barrel currently. We'll wait to see if we get any fireworks. Bloomberg senior energy reporter Stephen Stapczynski. Now, let's get to some of the other stories that are making news this morning. A billionaire Donald Trump supporter known for subprime auto loans has posted the former president's appeal bond in the civil fraud suit by New York State. Don Hankey's company lodged the $175 million bond 3 days before a court-imposed deadline, giving Trump a lifeline when he appeals. Hankey's fortune stems from car dealerships, real estate investments and financial investments. Elsewhere, McKinsey is offering 9 months' pay and career coaching services to some UK staff who'd like to leave. The move comes after the firm earlier warned some US consultants that they were running out of time to win promotions. McKinsey and its peers have trimmed their headcount and slowed the pace of hiring over the past year as demand from clients declines. In other news, Citigroup is said to have implemented a fresh round of job cuts in its US investment bank last week. Sources say technology, media and telecom were among the coverage areas hit the hardest, with senior bankers and junior roles affected. The cuts come as Citi says it's now concluded its planned changes. And the owner of the ship that rammed into a bridge in Baltimore last week is seeking to limit its liability to about $44 million. In a joint petition with Synergy Marine, Grace Ocean says the collapse was not due to any fault or neglect, so it shouldn't be held liable. The disaster killed 6 people and severely disrupted the eastern US transport network. Here in the UK, shop price inflation dropped to its lowest level in more than 2 years last month, with supermarkets competing to lure shoppers. According to the British Retail Consortium, the rate of price rises slowed to 1.3% in the year to March, sharply down from 2.5% Food price inflation eased for the 10th month in a row, its lowest since April 2022. Those are some of your top stories this morning. Now we can take a quick look at what else is happening this week. On Tuesday, we get Germany CPI. We have Fed speakers Bowman, Williams, Mester and Daly, and a load more besides. On Wednesday, NATO foreign ministers meet. There's also Euro area CPI, plus Fed Chair Jerome Powell speaking on the US economic outlook. And on Thursday, we've got even more Fed speakers before on Friday. It is, of course, Jobs Day with US payrolls and that jobs data. We've got plenty more coming up on the programme, so do stay with us. This is Bloomberg. Now, the leader of South Africa's main opposition, the Democratic Alliance's John Steenhuisen, says he would resist forming a coalition with the ruling ANC. Polls suggest the ANC could lose its majority in May's general election for the first time since coming to power 30 years ago. Steenhuisen spoke exclusively with Bloomberg's Jennifer Zabasajja.
We have already got a pre-prepared agreement about how we're going to work together, how we're going to stabilise a coalition, and how we're going to make sure it governs effectively.
Why not just have one single party ruling the country? I mean, is it because of the past 30 years of the ANC? What is it that you're so opposed to?
I think that if you look in South Africa, people are very brand loyal to organisations and brands. It would be, I think, foolhardy a year before an election to form a totally new party and expect it to get the name recognition and the traction.
I mean, we're seeing a lot of new parties.
We are seeing a lot of new parties, and we're seeing the fact that they're not making the breakthroughs that people would expect them to, precisely because they're unknown quantities. We're hoping that the multi-party charter, the whole, is going to end up being greater than the sum of the parts. The IFP can go on the hunt for votes in rural KwaZulu-Natal. The Freedom Front can bring votes in from rural parts of the Northwest and those communities. The ACDP can bring in the religious voters. And to bring all of those to the table to form a big pile of chips that can be used to be able to form a government.
What about the DA and the ANC?
No, we don't want to be in government with the ANC, and that's precisely...
So that is out of the question?
No, it's precisely why we formed the multi-party charter. My job is to get the ANC out of government. I don't think we're going to solve the country's problems by having the same people who are responsible for the economic crisis, the social crisis, and the infrastructure crisis sitting around the table. We've got to change them, and that's why the multi-party charter has said we will not do deals with the ANC or the EFF.
What if we see a scenario where the ANC still is somewhat in the majority? Is the DA going to rule out working
We will
with the
go back to the multi-party charter, and we will decide on what the best option for it. It may be a minority. Maybe we could form a minority government as a multi-party charter. I just think there's too many unknowns at this stage to say my focus is on getting the ANC way below 50% and getting a new set of people around the table so we can get our country off this low growth, high debt, high unemployment trajectory.
So that was South Africa's opposition leader, John Steenhuisen, speaking exclusively to Bloomberg's Jennifer Zabasajja. And I want to stay now with emerging markets and turn to Turkey, where President Recep Tayyip Erdogan has suffered a stinging defeat against the main opposition in local elections. For the impact on markets, we can bring in BNP Paribas Global Head of EM Credit Strategy, Trang Nguyen. Trang, great to have you with me. Yeah. Turkey, are we braced for a really watershed moment in macro policy?
So I don't think this would be categorized as watershed given the outcome over the weekend. You know, this is clearly a surprise. And the story we've seen in Turkey is that markets have been expecting this return to orthodoxy by Erdogan, which really surprised us after last year's elections. So if you look at asset prices, we've seen a substantial rally already. We're talking about multi-notch ratings upgrade. You know, we've seen that already in recent months. So the outcome over the weekend will inject some degree of uncertainty around this. But Erdogan has already spoken publicly about his commitment to reforms. So is it a game changer? I don't don't think so, but I think we should be bracing for more volatility here.
Okay, so we continue to hold our breath in Turkey. I want to take a trip round EM with you. Let's go to Argentina next. When do you expect the government to dollarize the economy? Because, of course, this was a big campaign promise of Milei.
Yeah, but, I think he's backtracked from that. So actually right now, what Milei is more focused on is reforms. And what he has working in his favor is a clean slate when it comes to negotiations with the IMF. Right. So I think that's really been what's been holding the rally in Argentina. Now, of course, the bill has suffered a lot of setback in Congress. I think we're going to see more watering down before it gets passed. But, again, I think the IMF story here is key. The dollarization, I think, now is currently on the back burner.
And, of course, all eyes are on that IMF meeting. What are you looking at from an EM perspective?
I mean, I think in 2 weeks we're going to see the meetings commence. I'll be there, and expectations again are very high. A lot of these stories are currently hinging on the continuation of IMF support. We have Argentina, Ecuador, Ukraine, Egypt, to name a few. And so a lot of these really rely on this ongoing support, not just from a balance of payment standpoint, but from a fiscal credibility. So IMF support is key. And just given the extent of the rally so far, any hiccups, I think, will result in a consolidation.
We mentioned Egypt. How long do you think that investors are going to need to feel confident about FX stabilization before they buy Egypt's debt?
Well, I think we've already seen that. The FDI inflows from the UAE deal is substantial, and I think that's been a game changer. And it's provided the central bank, the authorities, with some breathing room in order to enact the measures that they needed to do on the FX. So I think the confidence is already there. Now, again, we've seen a 20% plus rally in Egypt bonds so far. I think near term, the space for us to rally further is more limited. And again, we are waiting for more signals from the IMF meetings.
Okay, interesting. Just thinking about the US, though, we've had some interesting comments from the Citadel founder, Ken Griffin. He's been saying that it is a growing concern that cannot be overlooked, this issue of US national debt. How real a possibility is a US debt crisis, Trang, given the ripple effects for EM as well?
Well, if we have a US debt crisis, no one is immune. But I think on the bright side, I'd say that EM fundamentals are actually on the mend. I entered the year with a very bullish view on EM credit. I probably wasn't bullish enough, actually. The speed of this recovery, the speed and depth of the recovery has been quite profound. And EMCCC has rallied 22%. So why is that? Well, we have improving financing channels. We have improving debt fundamentals as well. And, the theme that I keep talking about is the idea that EM high yield countries in particular have access to alternative sources of financing. So debt to GDP metrics are actually on the decline for this year, and the higher debt costs that a lot of the developed market nations have to lock in are being avoided in EM because they have access to concessional sources of financing.
Well, that's interesting because I also read your comments on the EU's rules on greenwashing and green bonds in emerging markets. In a sense, is Brussels throwing the baby out with the bathwater, trying to stop greenwashing, but then not applying a specific enough lens when it comes to regulating EM bonds?
Yeah, so I think there's a bit of a stalling in the ESG momentum at the moment for that very reason. But I think there's also broad recognition that any kind of ambitious climate goals, any ambition on the energy transition agenda needs to scope in EM countries. And we actually see more EM countries now developing social ESG frameworks in their bond issuance, and that is a welcome initiative.
So then actually, do you see a move from the G to the S within ESG?
We see that already. And I think the S pillar is a bit more encompassing and broader. And so we see a lot more of those issuance in EM bonds recently.
All right, Trang Nguyen, looking fabulous as ever.
Yeah.
Thank you for joining me. That's BNP Paribas Global Head of EM Credit Strategy, Trang Nguyen, with a trip round EM markets. We'll have plenty more coming up, so stay with us. This is Bloomberg.
The report that came out this morning is pretty much in line with our expectations. We're making progress. This is good, but we need to see more. The decision to begin to reduce rates is a very, very important one. The economy is strong. We see very strong growth. We had growth for last year over 3%. We don't need to be in a hurry to cut. It means we can wait and become more confident. I don't think rates will go back down to the very, very low levels they were at before the pandemic. This economy doesn't feel like it's suffering.
So the Fed Chair Jay Powell speaking there, and of course the key influence on the Fed's thinking is going to be the US jobs report on Friday for March. This is really the key highlight of the week when it comes to economic data. And if we just think back to the last report, you can see that the unemployment reading was at a 2-year high. Estimates offer a 3.8% reading this time. And if you flip the board over, the last print saw the biggest revision to the month before in over a year. So really, we need to keep an eye on volatility here. If we flip the board again, you can see that jobs data surprises have been relatively strong. So this could be a very interesting day for markets on Friday. We'll have full coverage for you here on Bloomberg TV. You've already been seeing Fed rate cut bets being pushed back. Such a dramatic change from the start of the year. Of course, we had the factory data yesterday showing this resilience in the economy again, more resilient than economists had expected. Inflation falling more slowly as well than economists had expected. And there was one moment when actually you saw those pricing for the June cut slipping below 50%. So do we see even more of a pushback on that on Friday? We'll have full coverage for you here. Markets Today is up next. So stay with us. This is Bloomberg.